Okay, let's do a quick concept check here. And we're going to be comparing and contrasting the difference between a stop market order versus a stop limit order, and when to use them to get into trades and when to use them to get out of trades. So I've got an example here on Home Depot, which is looking like it's poised to break out to all-time highs. And it's got a big, old, fat, beautiful macro cup and handle pattern. When we see that pattern, we think it's got a good probability of breaking out and going to the upside. So we like that pattern there on Home Depot. And it's just poking its head up today above the recent high. So I'm going to zoom in here. And today's close is the confirmation signal I've been waiting for. So now I'm willing to buy this, but I'm only willing to buy into this trigger. And I'm going to use a nice little green color here. I'm going to buy into that if it goes up. And the trigger order I'm going to use is called a buy stop. Now, a buy stop is just a price trigger. So I'll set that price trigger up above today's high price of 214.08. Now, that buy stop, when I use a buy stop order, that's the trigger. That buy stop order can be paired with either a market order, an MKT market order, or a limit order. And when it comes to getting into trades, we prefer limits. We don't use buy stop markets to get in for one reason. What if the stock were to gap up? Let's say it gapped up here to 220, and that happens a lot of times when you get nice breakout patterns or pullback patterns. You get a lot of energy and you'll see things gap, just like you saw right here on a cup and handle pattern that gapped up. Now that one was a pretty easy gap, not too hard to catch, but other times a gap can ruin the reward to risk ratio, because if you have your sell stop order, let's imagine I had a sell stop loss down here and I was planning on buying at that price right there, but instead I got filled up here at this price. Well, that would change my reward to risk. It would change my risk profile. If I ended up getting filled at a higher price, I'd have a much bigger risk than I expected. So where you're going to use buy stop limits to get in. Now, let's flip this over and talk about if prices go up. Okay, so if the prices do go up tomorrow and we get filled on our buy stop limit, so we got our buy stop there, and it then will go buy stop limit. We'll put in a sell stop market. And we use stop markets to get out of trades because we don't want to limit our exit. We don't want to limit our ability to protect our capital. So the reason we do that is if the stock price runs down clean and hits the sell stop, that's not a big deal. But if it's running fast, like you get big hairy red candles, which you'll see sometimes after prices run up, or you get a gap down. Let's imagine the prices gap down and you had a stop limit and it went past the limit price and you don't get filled. You can get stuck holding the bag while that price, runs down. So stop markets to get out. Now, when you go to the trade tab here, and let's click on the ask price, for example, and I put in a buy stop limit to get in, I can create a first trigger sequential order and throw in a stop order to get out. So I'm going to go ahead and the buy stop limit, I could say, well, let's buy above 214.08. That's the daily high. So let's go 214. Let's be buyers if it goes above 214.15, a couple pennies above that. And then we'll say, but don't spend more than 214.25 or so. So I can control the price I'm willing to enter at. For the sell order, we'll make that a sell stop market. And when you put in stop market, you don't have to worry about the stop, the market, the limit part of it. You just put in the market, order, and after it gets triggered, it'll automatically get filled. So I think we should put that stop down below 208.50. And I'm just picking that down below the previous pivot. So if I change this down to 208.50, that is a stop market order, and I make both of those orders good till canceled, and that will make sure that those orders stay in place. That when I buy, I only buy if it goes above 214.15. I don't spend more than 214.25, and I have a distance to my stop loss. I can now calculate the difference in price between my limit and my stop, and I know what my maximum risk in points would be. And then I know that if it goes below that 208.50, it's going to trigger and send in the market order guaranteeing an exit. we use buy stop limits to get into trades, and we use sell stop markets to get out of these bullish trades. Now, when we flip that over bearish, we'll do another video for that. When we go bearish on trades, you'll see that we use the opposite. We use sell stop limits to get in and buy stop markets to exit. But when we're getting into trades, just remember, use stop limits when you need confirmation. That gives you the trigger and it helps you control the price. Use stop markets to get out. It gives you the trigger and it guarantees your exit.